Hey there, welcome back. We have one more thing I'd like to do in this section on inventory, and that is look at the effects of inventory on the financial statements. We've looked at how inventory affects all other steps of the accounting cycle, so now it's time to go back and get the last step, how it affects financial statements. We'll look at how inventory affects the income statement and the balance sheet. There really is no effect on the statement of changes in owner's equity, so we won't take a look at that in this video. Let's get started then with the income statement. There are two different formats that you can choose between. When presenting an income statement, you can choose to show a multi-step income statement, or you can choose to show a single-step income statement. It's important to note from the beginning that both of these formats would lead to the same net income. Net income doesn't change, just the way you're presenting it changes. Net income is what net income is. We'll look at the multi-step income statement first, and as its name suggests, there are several steps in determining what net income is. As I'll point out in a minute, two of those steps relate to principal operating activities, and this statement really distinguishes between income from operations and non-operating activities. It takes the position you're in business to sell some kind of product, and that it would be nice to highlight how much you made from selling the product and put anything that is peripheral to that underneath. You still need to include it, but to separate income from operations. Here's a multi-step income statement for an organization, PW Audio Supply, for the year ended December 31st, 2012. And notice how many steps it takes to get to net income. You have a step to get to net sales, subtract cost of goods sold, step to get to gross profit, subtract operating expenses, and then you have income from operations. Then you have peripheral items that net to $1,600, and you have net income. So several steps are involved in getting to net income. One of the things I like about the multi-step or multiple step income statement is it highlights how much money you made from being in the business that you're in this case, being an audio supply company. We made $30,000 from being in our principal business, and then there were a small amount of other revenues and gains and a small amount of other expenses and losses, resulting in net income of $31,600. I like highlighting how much you made from operations versus how much you made from other items. I want to draw your attention to two numbers before we move forward. I would like to point out gross profit, and I would like to point out net sales. We're going to use those in our next slide. One of the things I like about the multi-step income statement is it allows you to calculate the gross profit rate. And in the gross profit rate, it's nice to see that your gross profit's $144,000. Is that a lot or is that a little? It's hard to say if that's a good number or not, but when you compare it to sales, now you have something tangible that you can use to say, to aid you in determining how your performance was. 144,000 divided by 460,000 says your gross profit rate is 31.3%. Stated another way, for every dollar you make, you have 31 cents, or 31% of that left to cover all your remaining expenses. The gross profit rate is a measure of profitability, and it allows you to compare yourself year to year and see if you think you're doing better or worse, and allows you to get size out of it. So it doesn't matter what your sales or gross profit was. How did you do on generating a profit from your sales? I think it goes without saying gross profit needs to be a positive number. You shouldn't be buying inventory and selling it for less than you paid for it. Sounds like a bad idea, doesn't it? So that completes our analysis of the multiple step income statement. Let's take a look at the single step income statement. As its name suggests, there's only two steps in arriving at net income. You have total revenues, you subtract total expenses, and then you get to net income. Some people prefer this because they say a company doesn't realize any profit until all expenses have been paid and revenue exceeds those. And some people think it's simpler and easier to read. Maybe you'll agree or not with that. Here's our single step income statement for the same company. And notice right off, net income is still $31,600. It was on the multi-step as well. The single step groups all revenues and gains of any kind together and subtracts all expenses and losses from that number to come up with the resulting net income. It seems to say that not one particular type of revenue or expense is more or less important than another. And again, it doesn't change what net income is, it just changes how it's presented. Investors, as a general rule, don't have a preference for the multi-step or the single step. Their preference is in that you use a condensed reporting format. Notice we still have the same income statements, a multi-step statement and a single-step income statement, and we still have the same net income. The difference between this and previous slides is the amount of detail I'm providing to outsiders. While management most certainly would like to know the detail of what sales were, what returns and allowances were, cost of goods sold, gross profit, and all operating expenses. An investor is really more just interested in looking at the overall picture from a very summary level, 30 feet up, so to speak. So investors tend to prefer whatever you do include in your annual report to be in a condensed format. This is a very condensed format. I provided no detail for any of the categories at all, just the total number. That completes our peek at how inventory affects the income statement. Let's have a little go at looking at how it affects the balance sheet. Simple. Inventory changes the balance sheet only in one way and only in one area, and that's in assets. Inventory is a current asset. In fact, it's part of the definition of a current asset. Current asset is one that will be used or consumed within a year or an operating cycle, whichever is longer, or convert to cash within that same period of time. So you put money out to buy inventory, and then you sell it, and then you collect it. So inventory is part of the very definition of the operating cycle. Sometimes it makes the operating cycle longer than a year because things can get stuck in inventory for a while, not necessarily for a bad reason, but because it takes a long time to process it. Like cigarettes take, I guess, 7 years for the tobacco to properly become ripe. I wish it would rot personally, but it becomes ripe. A good whiskey takes 20 years. Building a ship, 2 years. Building a freeway, well, if you're in Salt Lake City, Utah in the year 2002, you can throw it up pretty fast. So, our look then at the balance sheet shows inventory only showing up in one place in merchandising business. That completes our look at how inventory affects the financial statements. We've now looked at how inventory runs completely through the accounting cycle. Thank you very much for joining me, and I hope you have a lovely rest of the day. Bye for now.